We spend our lives striving for it. We save it. We invest it. And sometimes we definitely lose sleep over it, money.
Hmm.
But when you really ask someone what money is, the answer is usually something like, well, it's a tool, a medium of exchange, the thing that came after bartering.
Right, the simple story.
But what if that simple, satisfying story, the one about the farmer trading chickens for grain, is actually one of the biggest economic fictions we've ever told ourselves?
That simple definition is precisely what we want to challenge today. Our whole mission in this deep dive is to get far beyond that textbook view, to synthesize some really challenging insights from, well, financial history, anthropology, even heterodox economics.
So we're digging into the invisible architecture of money.
Exactly. We're drawing on perspectives that see money not as a commodity, not as a tool for swaps, but as a kind of social contract. The core question we're trying to address is really foundational. Did money show up to fix the problems of barter? Or was it born fundamentally to account for debt?
Okay, let's unpack that right there at the source, because that origin story is just everywhere. The famous barter myth.
Mm-hmm.
It tells us ancient people were just constantly frustrated by the double coincidence of wants. You have I need firewood, but the person with the firewood only wants pottery. So boom, they invent money to make it all easier. It sounds so logical, almost inevitable.
It does.
So why do so many historians and anthropologists now just completely reject it?
Because that version of history is, well, it's essentially backwards. The archaeological and anthropological evidence, it just doesn't really show that complex formal barter markets existed before money.
Really?
Yeah. The real world problem wasn't trying to figure out how to swap fish for firewood. The problem was managing long-term social obligations, debts, tribute, all within a community or some kind of political structure.
So the initial need wasn't transactional, it was managerial. It was about keeping score.
Precisely. The dominant theory, and this is championed by thinkers like David Graeber, is that money first originated as a unit of account, a tool to measure obligations. It was a tool for state administration long before it was ever a tool for market exchange.
Can you give us a concrete example of this primordial debt idea?
Certainly. I mean, look at ancient Mesopotamia, specifically Babylonia. The earliest standardized unit of account wasn't a coin, it wasn't a lump of gold, it was the grain.
Grain.
The shekel, which we often think of as a unit of silver weight, was originally defined by the weight of a standard monthly ration of barley. This grain measure was used by temple and state authorities to measure tribute, taxes, and debt payments.
So the unit of account, it linked the monetary obligation directly to, like, basic survival, not to some fluctuating price in a marketplace.
Exactly. It reframes the whole relationship. The foundational interaction wasn't a neutral exchange between two equal merchants. It was the power dynamic between the creditor and the debtor. Money, then, is just the way we quantify that obligation.
Right. And economist A. Mitchell Innes, he called this the primitive law of commerce, didn't he?
He did. Debt, which is just an obligation with a number attached to it, is constantly creating and then canceling credits. Money is just the language we use to measure all of that. It's an IOU, but it's an IOU backed by a collective social structure, a temple, a state, a bank.
Okay, so let's fast forward to today. Because if money is really debt and promise, what on earth gives value to our digital dollars and euros? I mean, if it's not backed by gold, not backed by grain, its value has to rest on something much more ephemeral.
It rests entirely on collective imagination and trust. As the historian Yuval Noah Harari points out, our unique human trait is this ability to cooperate flexibly in huge numbers because we believe in shared fiction.
And money is the biggest fiction of them all.
It's arguably the most successful fiction ever invented.
I can't eat my currency. I can't build a house with it, yet pretty much every single person on the planet accepts it. That acceptance is the magic trick.
And that is the very definition of fiat money, from the Latin, let it be done. Its value is tied only to the full faith and credit of the government that issues it. And this leads us right to the state money theory, or chartalism.
Which argues that the government doesn't just print money, it actually creates the demand for it. How does that work?
It's actually quite elegant. The government imposes a liability on all of its citizens, let's say taxes, and then it names the one thing it will accept as payment for those taxes.
Its own currency.
Its own currency.
Hmm.
So since everyone has to pay taxes or, face penalties, everyone suddenly needs the government's currency. That mandate drives demand, and it doesn't matter if the currency is made of cowrie shells, gold, or just digital bytes.
So the state isn't just regulating trade, it's the ultimate debt manager, and its authority to tax is what guarantees the currency will always be in demand.
Precisely. And this flexibility, of course, is what allowed us to ditch the old commodity-backed systems. They just couldn't keep up with global trade. But
Yeah.
that flexibility is a double-edged sword.
Because if that collective faith is lost,
If people lose faith in the government's ability to manage it all responsibly, then that underlying fiction dissolves and the value just evaporates instantly.
that sets the stage perfectly for the modern banking system. So we know money is primarily debt and trust, enforced by the state, but where does the new money we use every day, the vast digital majority of it, actually come from? Most people think the central bank prints it all.
Right, but the reality is way more complex. The vast majority of money in circulation, what we call commercial bank money, is created within the system by commercial banks. And it happens through the simple act of issuing loans. This mechanism operates under what's called a fractional reserve system.
Meaning banks hold only a small fraction of what people deposit and then lend out the rest. Can you walk us through how that actually creates new money when a loan is made?
Sure, think of it like this. When you take out say, $100,000 mortgage, the bank doesn't go into its vault and pull out 100 grand from another customer's account. It simply credits $100,000 to your bank account. Poof! That debt, your obligation to the bank, is now an asset on the bank's balance sheet. And the deposit in your account is, functionally, new money.
Yeah.
It did not exist a moment ago.
And theoretically, that new deposit gets spent, moves through the system, and then 90% of that deposit gets loaned out again, and so on, which multiplies the initial deposit by some large factor. That's the money multiplier, right?
Correct. The theoretical multiplier is just the reciprocal of the reserve ratio. So if the ratio is 10%, the multiplier is 10. For decades, the assumption in macroeconomics was that central banks could tightly control the money supply just by adjusting that ratio.
But the real world, especially after the last big financial crisis, showed a pretty giant gap between that theory and what actually happens.
Oh, it completely shattered the illusion of tight control. The money multiplier theory, it assumes that banks will always want to lend out every single penny they are legally allowed to. It assumes they'll have zero excess reserves.
But banks are businesses. They're managed by risk, not by some mathematical formula.
Exactly. So banks often choose not to lend. And after the 2007-2008 crisis, central banks were just pouring liquidity into the system, but instead of lending it, commercial banks started accumulating excess reserves at a staggering pace.
How staggering are we talking?
To give you a sense of scale, before the crisis, excess reserves in the U.S. were negligible, tiny. By late 2013, they had climbed to over $2.3 trillion.
Wow.
That's $2.3 trillion that could have been multiplied tenfold through the system, but it wasn't. It just sat there, idle.
That's fascinating. The sheer volume of reserves just sitting there completely undermined the central bank's ability to control the money supply. It confirms that money creation is less of a physics problem and more of a behavioral one.
That's a great way to put it. The money supply is largely endogenous. It's created inside the system by the private choices of borrowers and lenders, and other factors like people choosing to hold cash or businesses just not spending their loan money. That stops the multiplication process too. The central bank provides the base, but it's the commercial banks that are really driving the engine.
This invisible architecture of debt, trust, and lending makes the system incredibly powerful, but also inherently fragile. So let's look at what happens when that fragile foundation is either completely destroyed or maybe courageously reset.
Well, Zimbabwe offers the classic cautionary tale. It's what happens when the state just abuses that collective fiction of fiat money. In the early 2000s, their central bank responded to economic problems by just printing money at an exponential rate.
And they completely lost public trust.
Completely. The hyperinflation rates are, they're almost impossible to comprehend. At its peak, prices were doubling every 24 hours.
Every day.
The currency lost 99.9% of its value. Think about the daily absurdity of that. You'd need enormous bags full of cash just to buy groceries. The government ended up issuing the infamous $100 trillion note.
And the takeaway is just that clear. When the authority breaks its promise, the trust dissolves and the currency becomes worthless paper.
Absolutely. The fiction dies.
Now let's turn to Iceland, post-2008. They faced a crisis of a similar scale, national debt ballooning to 9 times its GDP. But instead of the usual playbook of austerity and bailouts, they chose a really radical path.
Iceland showed that the debt relationship isn't some moral imperative, it's a political struggle. They took 3 really unconventional, aggressive steps. First, they let their currency devalue rapidly, which quickly slashed their debt burdens. Second, they let the major banks fail.
They didn't bail them out.
No bailouts. And the third, and maybe the most controversial step, was this massive debt restructuring. They protected domestic deposits, they capped household debt, but crucially, they stood up to international creditors and forced a huge renegotiation. It resulted in about a 40% haircut.
So they essentially defaulted on almost half of what they owed to foreign lenders.
They did. That action directly challenged the global norm that all debt must be repaid no matter the cost. They prioritized their local economy over the demands of international finance.
And the results were striking, weren't they?
They were. Even the IMF later noted that Iceland's recovery was significantly faster than many other nations that followed the traditional austerity path. It's just a powerful story showing that these debt relationships that underpin money, they aren't set in stone. They can be challenged.
So we've seen money as this highly institutionalized social invention defined by debt, measured by a unit of account, and sustained by trust. Knowing this invisible architecture, how does that change how we should look at our own finances?
Well, I think this understanding really empowers critical engagement. So first, question the narrative of value. Stop confusing the physical thing, the paper, the digital number, with the unit of account, the dollar or the euro.
Right.
Wealth isn't just piling up bills, it's accumulating assets denominated in that social unit. We have to remember the core purpose of production in this system is always to end up with more money than it started with.
Second, I guess, is to just acknowledge that every transaction involves this layer of trust and debt.
Exactly. Every time you use money, you are participating in a vast network of credit. Most money is quite literally a bank's IOU. Understanding that structure means you're not so shocked by things like bubbles or bank instability.
Instability isn't a bug, it's a feature.
It's an unavoidable feature of a system driven by private lending. Third, you can appreciate the central bank's true stabilizing role. Their main job isn't tight control of the money supply. Their critical role is providing an elastic supply of reserves as a lender of last resort to prevent the whole system from collapsing.
And finally, when finance gets really complicated, derivatives, jargon, how do we stay engaged?
You cut through the complexity and you focus on asking 2 simple questions. Why does this new thing exist? And what debt relationship does it represent? Because complexity is often just used to hide that fundamental debtor-creditor dynamic.
So what really stands out to you? We started by asking what money is, and we found it's not a simple tool. It's this profound, collective social fiction built on layers of debt, and it's sustained entirely by our willingness to trust powerful institutions.
And true financial literacy isn't just about counting bills, it's about understanding that invisible architecture that governs them. The history of money is one of this constant oscillation back and forth between physical commodities and virtual credit systems.
And as we move deeper into the 21st century, dominated by digital transactions, we are definitely moving back toward a period of virtual credit, aren't we? It's almost like the Middle Ages in that respect.
Exactly. And given that the financial world is often described as this hothouse of new techno religions, promising paradise through technology, we should ask a final question. Are things like cryptocurrencies and stablecoins just the next evolution of a social currency, a new kind of ledger? Or are they creating something truly new, a new kind of money, still backed ultimately by a new kind of collective decentralized trust? That question, I think, really defines the financial future you're going to live in.